Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Constellation Energy stock so we can determine if it's a buy or a sell. Constellation Energy is a producer of clean energy and a supplier of energy products and services. Its generating capacity includes nuclear, wind, solar, natural gas, and hydroelectric. It sells electricity, natural gas, and other energy-related products to various types of customers, including distribution utilities, municipalities, cooperatives, commercial, industrial, governmental, and residential. The company is headquartered in Baltimore, Maryland, and was founded in 1999. Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $81 a share, and they have 324 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2019. Then big negatives, negative 1.1 billion, negative 2.7 billion, and in 2022, negative 4 billion. This indicates they're investing a lot back into their business to grow it, so they're looking to scale and become bigger. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 19 and 20, negative in 21 and 22. Revenue is a sales for the company, and that goes up from 19 billion up to 24 billion. They did recently release their first quarter earnings. Revenue is up from 5.6 billion in the first quarter of 2022 to 7.6 billion in the first quarter of 2023. Let me show you a breakdown of the 7.6 billion. Of the 7.6 billion, 4.8 billion is from electric, 1.2 billion in the Mid-Atlantic region. Mid-Atlantic includes New Jersey, Maryland, Virginia, DC, etc. And that is up 13% from the first quarter of 2022. The Midwest region is down from 1.2 billion to 1 billion. The Midwest region includes these states, but the western part of the states. Mid-Atlantic is the eastern part of the states. Midwest also includes MISO. MISO includes a bunch of states like Arkansas, Indiana, as well as states that start with the letter M, like Minnesota, Missouri, Mississippi. New York is up almost 50% from 365 million to 535 million. ERCOT, which is Texas, Electric Reliability Council of Texas, that's down 28% from last year. Other power regions are 1.8 billion, down from last year. Other power regions include New England, Canada, and a bunch of other states. They generated 1.9 billion of other. Other includes wholesale and retail sales of natural gas, plus a lot of other small business activities. And they had a mark-to-market gain of 900 million. Last year they had a mark-to-market loss. Let's go back to the income statement. They spent 5.7 billion in purchasing the power and fuel, and they sold that power and fuel for 7.6 billion. So that's a profit of about 1.8 billion. They also had operating and maintenance expenses of 1.4 billion, depreciation, amortization, and taxes. So total expenses are 7.6 billion. So they're pretty much break even. Last year, a much higher operating profit with much lower revenue. They spent 107 million of interest on their debt, almost double of last year. But the reason their net income is similar to last year is because they had a gain on their income taxes. They received a credit of 131 million. Last year, they paid 53 million in taxes. Let's look at the capital structure. 11 billion of equity, 5.8 billion of debt. They're 66% equity, 34% debt. Their net debt is 5.3 billion. So they have about 400 million of cash on their balance sheet. I gave them a WACC of 7.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 48 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $35 billion. We divide that by 324 million shares. And we get a calculated stock price of 106. They're trading at 81, so they're trading at a 23% discount. It's a buy according to the model. Simply Wall Street has them valued at 187. They say the stock is 57% undervalued. 8 analysts priced this stock, and the average price target is 94. The low is 81, the high is 108. Another 12 analysts price this stock, and the average price target is 98. They say the stock is 20% undervalued. This is where the stock has been trading since they IPO'd. About 2 or 3 weeks after the IPO, the stock more than doubled. Then over the next month, the stock came down below its IPO price. Then it shot way up from around $10 to $100. It has come down about 18% from the peak, but it's still trading much higher than what it was at its IPO. They pay a quarterly dividend. They recently doubled it from 14 cents to 28 cents. That's a yield of 1.4%. There are 21 companies in the same industry as Constellation, and if Constellation has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a lot on CapEx, almost $2 billion. They have a good debt to equity ratio, much better than the median and average. More than half the companies on this list do not pay a dividend. They do pay a dividend, a little lower than average, but a lot lower than a few of the companies that pay a dividend. They have the biggest negative in free cash flow. They're the biggest company by far on this list. Their price to book is worse than the median average. We can't look at their PE or price to free cash flow. They have a really good price to sales ratio, much better than the median average. They generate lots of revenue, much more than anybody on this list. So to summarize, I have them trading at a 23% discount. They've been around 24 years. They're aggressively investing in their business to grow it, as you can see from negative free cash flows. If the investment in CapEx pays off, this could be a $100 billion stock in the next 2-3 years. I rank their free cash flow as 1 out of 10, their revenue 6 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.